Welcome to this explainer. Today, we're diving into a literal mystery hiding right in plain sight within the world of global energy trades. It's a story all about impossibly perfect market timing, massive, and I mean absolutely massive financial stakes, and this really murky intersection where international diplomacy meets high finance. If you've ever wondered how geopolitical shifts actually impact financial markets in real time, and more importantly, exactly who stands to benefit from that information, well, you're in exactly the right place.
Okay, let's dive into this. Just imagine for a second, what happens when you know the future of a war, say, exactly 20 minutes before everyone else? It honestly sounds like the plot of a Hollywood political thriller, right? But according to some incredibly eye-opening recent market data, this is a very real scenario that's been playing out right under our noses in global oil markets. We're going to explore exactly how advanced knowledge, or, impossibly lucky timing, translates into absolute financial windfalls.
$760 million. Just let that number sink in for a second. That is the exact size of a single massive bet placed by investors recently. And get this, they weren't betting that the price of oil would go up, they were betting heavily that it would violently fall. And they placed this absolute behemoth of a wager right before a major Middle East geopolitical announcement completely upended the market. So the obvious question here is, how did they know? Or maybe more accurately, actually, did they know?
Let's actually trace the exact timeline of how this whole thing unfolded on April 17th, because it is wild. According to data from the London Stock Exchange Group, between 12:24 and 12:25 GMT, investors dumped a combined 7,990 lots of Brent crude futures. Boom, there's our $760 million bet. Now, fast forward exactly 20 minutes to 12:45 GMT. Iran's foreign minister jumps on X and posts an announcement stating that the Strait of Hormuz is completely open to all commercial vessels for the remaining period of a ceasefire, specifically in line with the ceasefire in Lebanon. So what happens next? Literally minutes later, the price of crude oil drops by a staggering 11%. The timing is, frankly, just unbelievable.
Now, to really grasp how someone could rake in a fortune off an 11% price drop, we need to quickly break down what exactly was being traded here. We're talking about Brent crude futures. Essentially, these are financial contracts where buyers and sellers agree to trade oil at a set price on a future date. It's basically the go-to tool for speculating on price movements without ever having to figure out where to store actual physical barrels of oil. By selling these futures short, which simply means betting the price is going to tank, these anonymous investors position themselves to make an absolute killing the very precise moment that diplomatic announcement hit the wires.
Let's move to and see how this builds. Section 1, a pattern of perfect timing.
And this brilliantly illustrates the wider pattern we're tracking today. Because that super lucrative April 17th event, yeah, it wasn't just some bizarre one-off anomaly. Look at this timeline. On March 23rd, a $500 million bet was placed just 15 minutes before U.S. President Donald Trump announced a delay in attacks on Iran's energy infrastructure. Then, on April 7th, a $950 million bet was made mere hours before the U.S. and Iran announced a 2-week ceasefire. And then, of course, we have our April 17th trade, $760 million, just 20 minutes before the Strait of Hormuz announcement. We are talking about jaw-dropping sums of money and uncannily tight timeframes, right before major policy shifts from both the United States and Iran. And the immediate fallout from these trades? It's pretty jarring. When that March 23rd U.S. delay was announced, the price of crude didn't just dip, it plummeted by 15%. Following the April 17th announcement about the Strait of Hormuz, the market saw that massive 11% drop. You literally cannot deny the direct correlation here. It's like clockwork. Massive trades are executed, an announcement of de-escalation follows almost immediately, and the crude market takes a sudden, sharp nosedive, heavily rewarding whoever had the foresight or the intel to short the market just moments before.
Section 2, the opaque market.
We're essentially looking at two totally different realities operating right side by side. On the one hand, we've got public knowledge. The actual diplomacy, the ceasefire announcements, and the geopolitical moves unfolding in real time. This is the stuff the whole world gets to see. But on the flip side, we have private actions, these massive, perfectly timed derivative trades being executed in the shadows just minutes before the public is clued in. Regardless of the political figures or the nations involved here, this stark divide between what the public knows and what a select few private traders appear to be acting on, well, that is exactly what's triggering so much scrutiny and alarm among institutions right now.
U.S. lawmakers and legal experts are definitely sounding the alarm on this. They're pointing out that, and I quote, decisions around war and diplomacy can give some traders an edge in volatile and opaque derivatives markets. And they're absolutely right. When global stability is hanging by a thread, the derivatives market becomes hyper-reactive. The real fear here is that advanced knowledge of these highly sensitive diplomatic moves is being quietly leveraged for massive payouts, way before the broader market has any actual chance to react or adjust.
Now, what's really interesting about this slide is that these perfectly timed trades haven't exactly flown under the radar of authorities. The U.S. Commodity Futures Trading Commission, or the CFTC, has officially opened an investigation into a whole series of these oil futures trades. Specifically, they're digging into those highly suspicious March 23rd and April 7th wagers that magically happened shortly before major policy shifts by Trump related to the war in Iran. So now, regulators are actively hunting to see if there's an actual connection between the policymakers making these huge decisions and the market makers reaping all the financial rewards.
So the crucial point is perfectly captured in this four-step cycle we've been observing over the past few months of this conflict. Step 1, a massive, hundreds of millions of dollars shadow bet is placed out of nowhere. Step 2, within minutes or sometimes hours, a major geopolitical policy shift is announced to the entire world. Step 3, the crude market plummets, making those earlier bets incredibly lucrative. And finally, Step 4, regulators swoop in to open investigations into how on earth this happened. It's a predictable, highly profitable, and frankly, a deeply questionable loop.
Which leaves us with this final, lingering thought. In a world where diplomacy can literally move markets in a matter of minutes, who really profits from the fog of war? Are we just witnessing the moves of some incredibly savvy and bizarrely lucky investors? Or does this entire pattern point to a deeply compromised flow of sensitive global information? Honestly, the answer to that question